Right now, today, America pays $3 billion in interest every single day. Not per week, not per month. Every single 24 hours, $3 billion gone. That money leaves the U.S. Treasury and goes directly to bondholders worldwide. Many of those bondholders are foreign governments, China, Japan, and others. The Congressional Budget Office confirmed annual interest payments crossed $1 trillion in 2024. That single number represents a threshold America has never crossed in its history. For the first time ever, interest costs exceed what America spends on defense. America now spends more on debt interest than on protecting its own citizens, more than Medicare spending that keeps millions of elderly Americans alive daily, more than the entire federal education budget serving America's next generation completely. If Finance Insight is adding real value, please subscribe to the channel now. Hit that notification bell and never miss another critical financial update again. Back to the numbers, because what they reveal is genuinely deeply alarming. America's national debt officially stands at $38 trillion as of early 2026. Every American citizen personally owes $113,000 as their individual share of that debt. A family of four carries a $452,000 debt burden they never personally chose. These are not abstract government numbers. This is personal financial reality for everyone. The debt is not stable, contained, or slowing down in any measurable way. America is adding over $1 trillion in new debt every single 100 days. It took America 200 years to accumulate its very first $1 trillion today. That same amount gets added in roughly 3 months of spending. That acceleration tells the entire story about where American fiscal discipline currently stands. The Congressional Budget Office projects debt will reach $54 trillion by the year 2034. That projection assumes no major recession, no new war, and no new crisis. Any one of those events would push the debt significantly higher and faster. The IMF formally flagged U.S. fiscal policy in its April 2026 World Economic Outlook. The IMF specifically cited America's fiscal trajectory as a significant global stability risk. When the International Monetary Fund flags America, the entire world takes immediate notice. This is not a developing nation being warned. This is the world's largest economy. Moody's downgraded the United States sovereign credit rating, citing exactly these fiscal concerns. America lost its last perfect credit rating from a major agency because of debt. That downgrade is not symbolic. It has direct and measurable financial consequences. A lower credit rating means higher borrowing costs on every new bond America issues. Higher borrowing costs mean the $1 trillion annual interest bill grows even larger. This self-reinforcing cycle is what economists specifically call a fiscal debt spiral. J.P. Morgan analysts have used precisely that term when describing America's current fiscal trajectory. Understanding how America arrived at $38 trillion requires examining decades of spending decisions. The debt was $2.7 trillion when the famous New York debt clock was installed. That clock was installed in 1989, just 37 years ago by a private citizen. The owner installed it because he was alarmed by debt levels at $2.7 trillion. That figure today looks almost quaint against the current $38 trillion reality. Reagan-era deficits started the modern debt acceleration in the early 1980s. The Iraq and Afghanistan wars added roughly $8 trillion over 2 decades. The 2008 financial crisis response added trillions more through bailouts and stimulus spending. The COVID-19 pandemic response added another $5 trillion in emergency spending almost overnight. Each crisis required spending that was politically impossible to refuse at the time. Each spending surge permanently ratcheted the debt baseline higher without subsequent correction afterward. America has run a federal deficit, spending more than it collects, every year since 2001. That is 24 consecutive years of spending beyond revenues without a single exception. The last time America ran a genuine budget surplus was fiscal year 2001. Since that year, America has borrowed money every single year to fund operations. The accumulated effect of 24 years of deficits is exactly the $38 trillion reality. Now examine what the debt to GDP ratio actually reveals about America's fiscal position today. America's GDP stands at approximately $28 trillion as of early 2026 figures. A $38 trillion debt against a $28 trillion economy gives a ratio of 136%. The IMF considers debt above 90% of GDP a serious long-term sustainability concern. America is at 136%, well past every major international warning threshold. Post-World War II, United States had debt above 100% of GDP briefly. But that debt was paid down aggressively through 2 decades of strong economic growth. The political will and economic conditions that enabled that paydown no longer exist today. Today's political environment makes meaningful deficit reduction essentially impossible through normal legislative processes. The last serious deficit reduction attempt, the 2011 Budget Control Act, was eventually reversed. Every significant spending restraint measure in recent decades has ultimately been reversed or circumvented. The structural incentives of American politics consistently reward spending and punish fiscal restraint. Politicians who cut popular programs lose elections. This is the core fiscal paradox. And so the debt grows, the interest compounds, and the options narrow relentlessly. Now look specifically at where the money is actually going each year. The federal budget has three broad categories: mandatory spending, discretionary, and interest payments. Mandatory spending includes Social Security, Medicare, and Medicaid, legally required automatic payments. These mandatory programs collectively consume roughly 65% of all federal spending today. Discretionary spending covers defense, education, infrastructure, and everything else Congress annually approves. Interest payments on the debt now consume a larger share than ever before historically. In fiscal year 2024, interest payments consumed 18% of total federal revenues. Goldman Sachs projects that figure could rise to 24% of revenues by 2030. At 24%, nearly 1/4 of every tax dollar collected goes directly to creditors. That leaves dramatically less money for defense, infrastructure, healthcare, and everything Americans actually need. The squeeze is mathematical and inevitable as long as debt and rates remain elevated. The Federal Reserve's rate decisions directly and immediately impact America's debt interest burden. When the Fed raised rates aggressively in 2022 and 2023, borrowing costs surged sharply. America issues new Treasury bonds constantly to refinance its existing maturing debt obligations. As old low-rate bonds mature, they're replaced by new higher-rate bonds instead. The average interest rate on America's total debt is still being repriced upward gradually. This repricing process will continue for years as older cheap bonds expire. Even if rates fall, the damage from the repricing cycle is already substantially locked in. The Congressional Budget Office estimated this repricing effect alone adds hundreds of billions annually. That is new interest expense created not by new spending, but purely by rising rates. America is paying more for the same debt simply because the interest rate environment changed. This is the hidden accelerant inside the $38 trillion debt story that few explain. The debt number itself is alarming, but the interest rate dynamic makes it explosive. Social Security is simultaneously approaching its own fiscal inflection point with serious precision. The Social Security Trust Fund is projected to be depleted by 2033 by trustees. At depletion, benefits would automatically be cut to 77% of scheduled payments immediately. That would affect over 70 million Americans currently receiving Social Security benefits today. Without congressional action, that automatic cut arrives in approximately 7 years from now. Medicare faces similar trust fund pressures on a slightly longer but equally certain timeline. Both programs are simultaneously approaching financial stress at a moment of record national debt. The timing of these converging pressures is what makes this fiscal moment uniquely dangerous. There is no fiscal slack remaining, no easy reserves to absorb coming shocks. Every dollar of fiscal space has already been consumed by compounding debt and interest. The $38 trillion is not merely a number, it is the total of every compromise. Every war funded by borrowing, every crisis met with spending, every tax cut unfunded. The bill for all of those decisions is now sitting on America's doorstep permanently, and the interest meter is running every single minute of every single day still. The interest meter running every day is only half of the fiscal story. The other half is what America's creditors are quietly starting to do now. Foreign holders of U.S. Treasury bonds are the foundation of America's borrowing ability. Without foreign demand for treasuries, America cannot finance its deficits at current rates. Japan remains the largest foreign holder of U.S. Treasuries at approximately $1.1 trillion. China has been steadily reducing its Treasury holdings for several consecutive years now. China's holdings dropped to $682 billion, or the lowest level recorded since the year 2008. That reduction is not accidental portfolio rebalancing. It is a deliberate strategic signal. And when your largest creditors begin quietly reducing exposure, the warning cannot be ignored. The bond market has already started reflecting this growing creditor unease with America. The 10-year Treasury yield has been elevated and volatile throughout early 2026. Elevated yields mean America pays more interest on every new bond it issues. That directly and immediately worsens the already critical debt servicing cost spiral. The term premium, the extra yield investors demand for holding long-term U.S. bonds, is rising. Rising term premium signals that investors want compensation for perceived fiscal and inflation risk. When investors demand more compensation to hold American debt, something fundamental has shifted. America's Treasury bonds were once considered the safest asset on the entire planet. That perception of absolute safety is now being quietly but measurably challenged by markets. The dollar's share of global foreign exchange reserves has fallen from 71% to 57%. That 14-point decline represents trillions of dollars in reserve diversification away from America. Central banks are not moving away from dollars because they dislike America politically. They are moving because the fiscal mathematics of $38 trillion debt are genuinely alarming. Reserve managers at central banks read the same CBO projections that analysts do. They see a debt trajectory that leads toward either default, inflation, or monetization. None of those three outcomes is acceptable to a responsible foreign reserve manager. So they quietly diversify into gold, euros, yuan, and other alternative reserve assets. Gold purchases by central banks exceeded 1,000 tons annually for 3 consecutive years running. That gold buying is directly connected to concerns about long-term dollar fiscal sustainability. The world is not abandoning the dollar today, but it is building contingency plans. Those contingency plans themselves create real and measurable pressure on America's borrowing costs. Now examine what realistic solutions to the debt problem actually require in practice. Every credible fiscal economist agrees the solution requires both spending cuts and revenue increases. The political reality of Washington makes that combination nearly impossible to achieve currently. The mandatory spending programs, Social Security and Medicare, are politically untouchable for most legislators. These programs serve over 70 million Americans who vote in extremely high numbers. No politician who touches Social Security benefits survives the subsequent election cycle intact. Defense spending is similarly protected by powerful and well-funded political constituencies in Washington. The discretionary budget, education, infrastructure, research, is relatively small and already squeezed tightly. Cutting the entire discretionary non-defense budget would not meaningfully address the deficit alone. The math simply does not work without addressing mandatory programs and revenue simultaneously. Tax increases face equally powerful political resistance from different but equally determined constituencies. America's effective federal tax revenue as a percentage of GDP sits around 17%. Most peer economies collect 25 to 35% of GDP in tax revenues. That gap represents trillions in potential revenue that political consensus currently prevents collecting. The combination of politically protected spending and politically blocked revenues creates a fiscal trap. Washington is structurally unable to solve a problem that mathematics says must be solved. This institutional paralysis is precisely what concerns the IMF, Moody's, and Goldman Sachs most. It is not that America lacks the economic capacity to address its debt problem. It is that the political system cannot generate the will to actually do so. History shows that fiscal crises resolve themselves one way or another, always eventually, either through deliberate policy action or through forced adjustment imposed by financial markets directly. Deliberate policy adjustment is painful but controllable. Governments choose the timing and tools. Market-forced adjustment is disorderly, sudden, and far more economically destructive for ordinary citizens. Greece in 2010 experienced market-forced adjustment. It was devastating for Greek households entirely. Argentina has experienced market-forced fiscal adjustment multiple times with catastrophic social consequences. America is not Greece or Argentina. Its scale and dollar reserve status provide protection. But that protection is not infinite. It is being gradually and measurably eroded right now. The dollar's reserve currency status gives America what economists call an exorbitant privilege. That privilege allows America to borrow more cheaply than any other nation on earth. But privilege is not permanent. It is maintained only through demonstrated fiscal responsibility. At $38 trillion and growing, that demonstration of responsibility is becoming increasingly difficult. The BRICS nations are actively building alternative payment and reserve infrastructure for this reason. A world with fewer dollar transactions means fewer automatic buyers for U.S. Treasury bonds. Fewer automatic Treasury buyers means higher yields and higher borrowing costs for America permanently. This feedback loop connects America's debt problem directly to every aspect of global finance. Now, consider what this fiscal reality means for ordinary American households going forward specifically. The $1 trillion annual interest payment does not exist in a fiscal vacuum alone. Every dollar spent on interest is a dollar unavailable for something Americans actually need. Infrastructure investment has been chronically underfunded for decades because of competing fiscal priorities. The American Society of Civil Engineers gives U.S. infrastructure an overall grade of C-. Crumbling bridges, aging water systems, and congested roads all reflect chronic underinvestment over decades. That underinvestment is a direct consequence of a budget increasingly consumed by interest payments. Research and development funding, the engine of long-term American economic competitiveness, faces similar pressure. America's lead in technology and innovation was built on decades of robust federal research investment. That investment pipeline is under increasing pressure from a budget that has no fiscal room. Education funding faces identical constraints as the mandatory and interest spending crowds out discretionary programs. The next generation of Americans will inherit both the debt and the consequences of underinvestment. They will pay higher taxes, receive reduced benefits, and inherit deteriorating public infrastructure simultaneously. This intergenerational dimension of the debt is perhaps its most morally troubling aspect entirely. Decisions made by previous generations are creating binding fiscal constraints on generations not yet born. The 2033 Social Security depletion deadline is not a political talking point. It is math. The CBO debt projection to $54 trillion by 2034 is not partisan. It is data. The Moody's downgrade was not ideological. It was a credit assessment based on evidence. All of these signals point in exactly the same direction with remarkable and uncomfortable consistency. America's fiscal position is deteriorating faster than its political system can respond to it. The $38 trillion is not the ceiling. At current trajectories, it is the floor. Every serious financial institution that has examined these numbers has reached the same conclusion. The trajectory is unsustainable. The only remaining question is how the adjustment eventually arrives. What should ordinary Americans do while their government navigates this extraordinary fiscal challenge ahead? Build personal financial resilience, reduce personal debt aggressively, and increase liquid emergency savings now. Understand that higher future taxes are a near certainty regardless of current political positioning today. Diversify investments across asset classes that historically perform well during periods of fiscal stress. Gold, real assets, and international diversification all offer meaningful protection during sovereign fiscal pressure. Monitor Treasury yields closely. Rising yields are the bond market's earliest warning signal always. The fiscal cliff is not a future event to be casually dismissed or ignored. The data, the downgrades, the IMF warnings, and the bond market are all aligned now. Every number in this story points toward one unavoidable conclusion that demands serious attention. America is spending money it does not have to pay interest on money it borrowed. That cycle ends. The only question remaining is whether America chooses how it ends. If Finance Insight is delivering real value, subscribe now and hit the notification bell. Drop your biggest question about America's debt crisis in the comments below right now.